Welcome to Deep Macro Lens. Right now, the U.S. Federal Reserve is standing at perhaps the most complex crossroads in its modern history. The Fed must not only manage its dual mandates of price stability and maximum employment, but also steer the economy through unprecedented geopolitical storms, escalating trade conflicts, and the growing momentum of global de-dollarization. But what exactly is the Fed seeing, and what might they be missing? Are their upcoming policy choices truly solutions, or are they simply prolonging deeper structural problems? In today's analysis, we'll move beyond the mainstream narrative, diving deep into the forces shaping the Fed's next moves, and exploring why these decisions could reshape the entire global financial order. Let's decode the reality behind the headlines. Their long-run inflation objective is 2%, as measured by the Personal Consumption Expenditures (PCE) price index. Since the beginning of the year, the Federal Open Market Committee, FOMC, has consistently maintained the federal funds rate at 4.25% to 4%. This marks the fourth consecutive meeting they have held rates steady. Chairman Powell asserts the Fed is well-positioned to wait to learn more before adjusting policy. However, within the FOMC, significant divisions persist. Governors Michelle Bowman and Christopher Waller, both appointed under the Trump administration, are strong proponents of early rate cuts, even as early as July. They argue that the inflationary impact from tariffs has not been as severe as feared, and delaying cuts risks the labor market. Conversely, Chairman Powell and San Francisco Fed President Mary Daly advocate for continued patience, preferring to observe how inflation responds to tariffs over the summer, potentially waiting more toward the fall for any adjustments. Let's look at this data table. It allows us to directly compare recent economic data with the Fed's own projections. Why does the Fed forecast PCE inflation to rise to 3.0% by the end of 2025, when current CPI is only 2.4%? What factors are driving this anticipated increase? With the unemployment rate projected to tick up slightly to 4.5% by Q4 2025, is the Fed implicitly acknowledging an upcoming weakening of the labor market, and if so, why does it maintain a wait-and-see stance? Chairman Powell consistently emphasizes that monetary policy must be forward-looking. But how can a central bank truly be forward-looking when the future is profoundly opaque and subject to unpredictable non-economic policy shifts like tariffs? Furthermore, political pressure from the White House, with public criticisms aimed at Chairman Powell, threatens the Fed's institutional independence. This autonomy is considered crucial for its long-term effectiveness. Is the Fed's current pause a tacit acknowledgement of the limits of its own predictability in a volatile environment, or a significant gamble on continued public confidence in the Fed's ability to control prices? Recent inflation data presents a mixed picture. CPI showed a modest 0.1% month-over-month increase and a 2.4% year-over-year rise. The Fed's preferred measure, PCE, stood at 2.1% in April, nearly aligning with its 2% target. However, core inflation remains slightly higher at 2.5%, indicating persistent underlying price pressures. This is arguably the most contentious point. Chairman Powell acknowledges that increases in tariffs this year are likely to push up prices. While the Fed typically expects this tariff-induced price increase to be temporary, they explicitly state the need for more data to confirm this assumption. Conversely, Bowman and Waller argue that the inflationary impact of tariffs may be smaller and slower than initially expected. However, external economists forecast inflation to rise to 3% by year-end, i.e., and the IMF projects U.S. inflation to increase by 1 percentage point due to tariffs. Wage growth has shown signs of moderating while still outpacing inflation. The labor market is generally not considered by the Fed to be a source of significant inflationary pressures. However, some analyses suggest that wage growth in low-skill services has been a key driver of supercore inflation, and an acceleration in high-skill service wage growth could lead to future inflationary pressures. Beyond tariffs, global supply chain disruptions are identified as significant long-run drivers of inflation. Geopolitical conflicts, especially in the Middle East, have reignited fears of a prolonged inflationary cycle. Oil prices have surged, with geopolitical risk itself commanding a significant price premium. A full disruption of the Strait of Hormuz could push prices to $120 a barrel. Research indicates that geopolitical risk shocks can have a positive and statistically significant effect on headline inflation within 1 year. The combination of tariffs acting as a supply shock, increasing prices, and simultaneously weakening aggregate demand, slowing spending, creates a classic stagflationary scenario. This is a significant complication. Raising rates to fight inflation would further depress demand and potentially increase unemployment, while cutting rates to stimulate growth would likely fuel inflation. Can the Fed address both problems simultaneously with its existing tools? While the Fed asserts that longer-term inflation expectations remain consistent with our 2% goal, and investors' views reinforce the Fed's assessment that inflation expectations remain well anchored, surveys of households and businesses indicate that near-term measures of inflation expectations have moved up. What are the implications of this divergence between the Fed's and markets' perception of anchored expectations versus the public's rising short and medium-term expectations for the Fed's long-term credibility? The U.S. labor market continues to exhibit remarkable resilience. The unemployment rate remains at a historically low 4.2% in May 2025, a level the Fed considers at or near maximum employment. Non-farm payrolls averaged a moderate 124,000 per month in the first 5 months of the year. Despite the overall strength, subtle cracks have begun to appear. The housing sector is slowing due to elevated borrowing costs. The pace of hiring overall has also moderated. Fed Governor Waller has pointed to rising unemployment among recent college graduates as a potential early indicator of weakening economic conditions. The Fed's own Summary of Economic Projections, SEP, forecasts the unemployment rate to tick up slightly to 4.5% by Q4 2025, suggesting an anticipated weakening. Monetary policy changes operate with long and variable lags. Does the Fed face the risk of over-tightening if it waits too long for clear signs of labor market deterioration, as the impact of any subsequent rate cuts would only be felt much later? Governor Waller's argument for cutting rates before the labor market noticeably worsened directly addresses this inherent lag risk. The Fed's statutory goal of maximum employment is a broad-based and inclusive goal that is not directly measurable and changes over time. Could the aggregate unemployment rate be masking underlying sectoral distress or structural shifts in the labor market due to tariff impacts? The tariff trade war has maintained the highest tariff rates in decades in the U.S., putting significant pressure on the U.S. economy and having moderately negative effects on global GDP. Unilateral U.S. tariff hikes act as an adverse supply shock, increasing domestic production costs and eroding purchasing power. Forecasts indicate these tariffs could push U.S. inflation up by 2.3% in the short run, reducing U.S. GDP growth by 0.9 percentage points in 2025. This table is critically important. It quantifies the tangible economic costs of escalating trade tensions. Do the consistent and significant downgrades in global and U.S. GDP growth forecasts by leading international organizations, explicitly linked to the impact of tariffs, provide undeniable evidence of the profound influence of geopolitical factors, challenging mainstream media optimism? Simmering conflicts in the Middle East have reignited fears of a prolonged inflationary cycle. Oil prices have surged, with geopolitical risk itself commanding a significant price premium. A 10% oil price rise could boost CPI by 0.2 to 0.3 percentage points. The real danger lies in second-round effects, where households and firms begin to bake elevated energy costs into long-term inflation expectations. The rise of BRICS and de-dollarization is also a notable trend. The expanded BRICS bloc, now accounting for approximately 46% of global GDP and 40% of global trade, represents a formidable economic force challenging the traditional dominance of Western powers. Through institutions like the New Development Bank, NDB, BRICS nations offer financing that bypasses the conditionalities of the IMF and World Bank. China's yuan has gained increasing acceptance in bilateral transactions, strategically reducing reliance on the U.S. dollar. while the US dollar still overwhelmingly dominates global foreign exchange transactions. And international debt/trade invoicing. De-dollarization efforts are growing. Central bank digital currencies, CBDCs, are emerging as a potentially revolutionary development for cross-border payments. While dollar dominance will not collapse overnight, are these efforts gradually but inexorably eroding its global hegemony, raising the critical question about the US's future ability to finance its debt? The 1970s presented a unique challenge: stagflation, a debilitating combination of high inflation and high unemployment. The Fed's primary tool, the federal funds rate, proved insufficient to address both simultaneously. It was only with Paul Volcker's appointment as Fed chair in 1999 that decisive action was taken. Volcker aggressively raised interest rates, reaching 18% in 1980, to quell double-digit inflation. This policy led to a brief but severe recession in the early 1980s, with unemployment peaking near 11%. This historical comparison hobble is indispensable for a deeper understanding of the current context. Given the historical effectiveness and associated economic pain of Volcker's aggressive rate hikes, is the Fed's current more cautious wait-and-see approach a sign of prudent adaptation to a new era, or a dangerous echo of the 1970s initial slow and indecisive response to rising inflation? The Fed's responses to the dot-com bubble, prolonged low interest rates, and the 2008 financial crisis, quantitative easing, liquidity provision to non-banks, represent significant innovations in monetary policy. While these unconventional tools were deemed necessary to avert immediate crises, could they have unforeseen and profound long-term side effects? Does each solution to a crisis, especially those involving unconventional measures, create new vulnerabilities or distort market mechanisms, thereby generating new complex challenges for future generations of the Fed? Leading international organizations, including the International Monetary Fund, IMF, the World Bank, and the World Economic Forum, WEF, consistently identify escalating trade tensions and heightened policy uncertainty as major headwinds to global economic growth. Global growth forecasts have been significantly downgraded across the board. The IMF's April 2025 World Economic Outlook, WEO, projects global growth to fall to 2.8% in 2025, largely due to the impact of tariffs. The World Bank expects global growth to slow to 2.3% in 2025, marking the weakest pace in 17 years outside of outright recessions. The IMF specifically notes that the U.S. effective tariff rate surged past levels reached during the Great Depression, and that counter-responses from major trading partners significantly pushed up the global rate. This policy-induced uncertainty, originating from the U.S., is considered a major driver of the economic outlook globally. The WEF's 2025 Global Risks Report also emphasizes that, if the coming months see a spiral of tariffs and other trade-restricting measures globally, the economic consequences could be significant. Is the consensus among these institutions regarding slowing global growth, largely due to trade policies and policy uncertainty, a clear warning for central banks worldwide, including the Fed? The Fed is at a crossroads, where its decisions will not only shape the U.S. economic future, but also have profound implications for the global economic order. Mixed inflation data, a resilient but cooling labor market, and especially the geopolitical shocks induced by U.S. tariff policy and conflicts in the Middle East, are creating an unprecedentedly complex policy environment. The Fed's current pause reflects a necessary caution in the face of extreme uncertainty. However, maintaining this stance for too long, while tariff-induced stagflationary risks become clearer, could lead to unintended consequences. History has offered costly lessons about reacting slowly to inflation and the long-term side effects of unconventional monetary policies. Meanwhile, the rise of BRICS and de-dollarization efforts are signaling a long-term structural shift in the global financial system. While the dollar retains its dominance, these strategic moves are gradually eroding its hegemony, which will have profound implications for the U.S.'s future ability to finance its debt. The Fed faces a dual challenge, not only to navigate economic forces, but also to maintain its credibility and independence amidst increasing political pressure. Its predictability is constrained by unexpected policy shifts And its tools, designed for simpler problems, are being tested by a multifaceted environment. So, in your opinion, is the Fed saving the economy or prolonging its agony? If the world no longer needs the USD, who will pay America's debt? If you found this content valuable, please subscribe to our channel to stay updated with the most insightful analyses on global economics and geopolitics.